Good afternoon, this is Jim Perry at Perry Capital, July 23rd, and this is our weekly podcast. We're going to talk about 6 things today. The first one being the Fed and Mr. Powell and the perceived change in priorities of the Fed's strategy, that little pivot that the market is telling us about. The next thing we're going to talk about is the economy between now and the election. We want to know what's going to happen toward the end of the summer and into the fall. Especially through this earnings seasons and the next one before the election. Speaking of the election, let's talk about Trump. It looks like he's got the lead in the polls, pretty much everyone that you can see. We don't know who the Democratic contender is going to be yet. We can assume it's Kamala, but that may change. But the platform will probably not change that much because the Democratic Party has an agenda and a priority which they will continue to push forward. So we want to talk about those differences. Now let's assume for a minute that Trump's going to win because today, this week, polls say he will. What is a Trump economy going to look like in 2025? Spending, taxation, revenues, supply, demand, income, spending. Once we get to that, let's talk about how you can be best positioned for these perceived changes. Perry Capital weekly strategy report always has our portfolio in it. We're going to talk about where we're positioned, what it means, and why you might want to consider those kinds of moves. Finally, the last little portion of this is going to be really about the information that we're getting this week. There's some big stuff coming up, especially if there's an inflation figure and some housing data. And we're getting earnings. So what does the market look like this week and what to expect before we get to Friday afternoon? Section 1 of the podcast, we're going to talk about the Fed and the Fed's pivot. What do we know for sure? Fed's meeting is July 31st. They will not cut rates. They will also be meeting on September 18th. The market currently says that the Fed will cut the Fed funds rate on the 18th. Maybe they will, maybe they won't. There's a lot of data to come before that happens. We'll talk about the economy in a minute. But right now, we know that inflation is running at 3.3% and GDP is running at about 2.5%. So the economy is inflating faster than it's growing. And if the Fed is going to shift its focus toward unemployment, they're going to be watching these unemployment numbers a lot closer than they have been in the last 3 or 4 months. So that's what we've got to watch out with the Fed. I do think we've got time to really debate about a Fed cut, but what we're going to talk about first and how we're going to get there is the economy. That's going to be section 2. That's coming up in just a second here. This is section 2 of this weekly podcast. We're going to talk about the Fed's perceived pivot on its interest rate policy. What do we know for sure? No Fed cut on July 31st. That's a week from tomorrow. The market is currently pricing in a Fed cut on September 18th, but that's a long way away and a lot can happen. Should they cut rates? If you talk to a real estate developer or anybody that's in the interest rate sensitive sector of the economy, they're screaming for rate cuts. But the people that are suffering in the broader economy are screaming about higher inflation prices, which really aren't going down. We'll talk about that in a minute. But the point is, the Fed's at 5.5%. They've been here for a year, and the stock market has gone up, as you know, 50%. It seems to me that there's plenty of stimulus in the economy. Otherwise, the stock market wouldn't be at all-time highs, and credit spreads wouldn't be at all-time lows. So let's talk about the economy in the next section here. This is section 3 of the weekly podcast. We're going to dig into the economy a little bit here. We're going to tell you where it is, where it's been, and where we think it's going. First off, as I said in the previous note, the Fed funds rate's been at 5.5% since last July. I think the Fed has kept rates here and was convinced that the economy would slow down by now, but it hasn't. The unemployment rate is marginally above where it's been at the lows for this whole cycle at 4.1%. What we do know is that the Fed has been very worried about the possibility of a lagged effect of these hikes. I'm not so sure that's really true. I think the economy moves so quickly right now that any effect that's on the economy has already gone through. I think there's a ton of money in the system. I know my real estate development friends and real estate investors would disagree with me. Anybody that's in the interest rate sensitive sector of the economy has been screaming for rate cuts for a year or longer. That will continue. They're talking their book, but they might have a point because there may be some bankruptcies out there. We know that debt's going up with credit cards and automobile stuff. I personally think the economy is strong enough to handle this stuff. I think GDP is going to come in at 2.7% or more for Q2. Corporate earnings, which we're getting this week, are strong. And I think that the companies that have driven the stock market here are driving the economy. They're spending money on infrastructure, and they are being supported by a tremendous amount of government spending. National debt is, as we all know now, $35 trillion. The budget deficit is $2 trillion, and the trade deficit is as bad as it's ever been. That is why we have not had a slowdown or negative growth. What next? I think what we have to look at is employment. And it's so hard to figure out because we don't know how many illegal immigrants are in the country and how much they're working and what they're doing to the denominator and the nominator of the GDP calculations that the Fed has, which we know are all wrong. The fact is the workforce has never been larger, and wage gains across the variety of income levels and wage levels, according to the Atlanta Fed, wages are still growing at 4.7%. I think inflation is still a bigger problem. I think the economy can handle 5.5% for a lot longer. I don't think that the Fed's going to cut this year. We'll see how it goes. We'll talk about that in the next section. This is section 4 of the weekly podcast. I want to talk about the market valuations and what it means. I'm of the view that interest rates are still stimulative, although the Fed would argue against that, although I don't know what numbers they're looking at. The Chicago Fed says they've been, the monetary overlay interest rates are as stimulative as they've been for the last 2 or 3 years. But let's just talk about earnings and valuations for a second. What do we know about earnings? I mean, the stock market really shows it's a barometer of the health of corporate America. And earnings growth has been very good. We're in the middle of earnings season now. I think the expectations are for an earnings growth of 20%. That's a lot different than it was post-pandemic. We had an earnings recession. And ultimately, valuations in the stock market are driven by earnings, and earnings are driven by the health of the economy. And from my perch, it looks like the economy is still doing pretty well. GDP is going to be 2.5%, maybe 3%. That's up at least a percentage point and a half from Q1. I think corporate America is making money, not across the board. We know that concentration in valuations is narrow, and we know that the earnings growth of the few and the strong and the large, especially in AI, are doing better than just about anybody else. We've got a really good set of tailwinds that are helping corporate growth. And you know, when you listen to these earnings calls, the CEO said that. We've got good stimulus coming from the government still, which is inflationary, but you know, it's a lot of money. The consumer's in good shape. I think that consumer demand will continue to drive earnings growth. And I also think that, you know, companies are getting better at managing this economy. It's much more service oriented, and I think there's going to be more of it coming this way. So valuations, I'm okay with them. Rotations into small stocks, I don't think that's a good idea. I think you stick with what's gotten us here. The few, the strong, the big, and the technically proficient companies that are driving the AI revolution. As far as interest rates are concerned, 10-year Treasury yields at 4.25%. They're down 50 basis points from the highs of this year. And even last year, they're at 5%. So rates are pretty low. And I think they're stimulative. Housing market is expensive. That's why it's slowing down. Rental market is expensive and not slowing down. And the automobile market is, automobile prices are at all-time highs, just like houses are. Eventually that's going to slow demand, but it's not now and it's not before the election. So look for the economy to expand into the election. Look for the government to continue to draw spending from the future to the present. They want to get reelected. I would do the same thing. And stick with what's gotten us here in the stock market. I think you'll do well. And you don't need to buy bonds right now. You can buy T-bills at 5.35 rather than a 10-year note at 4.25. I think that's a better deal on a risk-reward basis as we get through to the election. Okay, this is section 5 of the weekly podcast. We're going to talk about what the economy looks like under a Trump administration. The reason we're starting with that is because that's what we know so far. The probabilities that Trump beats a Democratic challenger remain at 2-1. That's where they were last week. And those odds had gone up since the assassination, obviously. But right now, that's what we know. So what do we know about Trump? Trump is going to increase tariffs against China for sure, and he is going to deregulate the oil and gas industry, and probably other industries as well, likely finance. That'll help. He's also going to shrink the federal government, and that's going to hurt. That's going to slow the economy down a little bit. I think he'll decrease government spending in almost every area of the economy except for the military. I do think he can disentangle this country's involvement in the regional wars that could potentially spiral out of control. I think support for Israel can go up to end this thing, and support for Ukraine can go up to end this thing. And I think that the Iranians will be less of a military threat in a year than they are now. That's my view. Maybe people don't agree with that, but that's what Trump wants to do. Whether he can do it or not, and he can do it successfully, is another story. As far as immigration and deficit spending and debts, immigration is a very, very important issue for this country, and I am a strong supporter of immigration. We need a lot of it, and we get a lot of it. Legal immigration to this country has been running at over 1 million people for 20 years, but not 20 million people. The people that come into this country have to want to come into this country, have to want to work, and they have to be able to give back to the country a little bit more. So I think that if the immigration policy gets straightened out, which I think it can do, stronger, harder working, motivated people coming to this country would be great. And the people that are using it as an escape hatch and weakening the country, I think that will be a positive development, because under Trump, the real issue is immigration and the effects on crime. That's what the domestic voter wants. So next topic, this is section 6 of the weekly podcast. I want to give you a little heads up about what we're looking at this week and what it means. We're getting some housing data, and we know that housing sales, new and existing, are falling. That doesn't mean demand's down. It means that sales are falling because people can't afford them. Home prices are at all-time highs. All right, existing homes, new home sales, new homes, existing homes, prices are at all-time highs. That means that rents are at all-time highs because people can't afford the houses. So the inflation that we see and we're going to get on Friday with the Fed's preferred measure, the core PCE data, big chunk of that is shelter, and those shelter wage or those shelter inflation increases, shelter prices are not going down. So I think that inflation is going to stay much stickier than people think. Core PCE was running at about 1.5% before the pandemic. It's obviously down from much higher levels at the beginning of the pandemic, but it's still running at about 2.5%, 2.7%. So we're a long way from 2. I am certain the Fed will not cut in July, and I am certain that they are not going to raise rates anytime soon. The question is, when's the cut coming? We're going to know a lot more data this week and next week, and into the employment report, which will be the first Friday of the month. I'll be watching very closely, I think you can see what we're thinking on my alerts. Tune in next week and I'll tell you what the market reacted to as far as the inflation data that we're going to be seeing at the end of the week. Okay? Thank you very much.